In this video, we're going over a day trade recap from Dr. Metals. Dr. Metals is one of the best zero DTE traders in the world, and he has a course out called the Statistical Day Trading course. If you want to learn from him, we encourage you to take a look at that course or join the Dorian Trader, and you can learn firsthand from him and others at the Dorian Trader. So, all right, looking at
Hey
oil.
O'Brien, Doc here.
Hey, Doc, how you doing?
Good. Uh, had some good time to just kind of really watch the trade today. Had a lot of work at my desk. Was able to kind of babysit a little bit
Uh,
of a stressful, well, a challenge day a little bit with zero DT. We had a little chop going on midday
mhm.
and whatnot. It was a big drop and then come back up and all that. Interesting. We had a little red high impact news today with the I guess it was the housing stuff, and I don't
Yeah.
know how much that really did things. So that came out at like 10 Eastern, and when I got into this trade initially at 11:15, things kind of dropped a little bit, and then it was like that rally up, and I had to adjust a couple different things today.
Mhm.
So first off, looks like my initial call position was at 54.90, and my initial put position was the 54.25. And I went in a little bit bigger size today, principally because I knew I had time to watch it,
Mhm. Mhm.
And I do stand by my assertion that, if you've got actually time to sit there and babysit the trade and, you've got the appropriate amount of buying power to adjust your shorts and that kind of thing, you can definitely win likely that 80% time, and really have a good expectancy. So it looks like basically I got stopped out on the 54.90 and the call position. And besides re-entering again at that 54, is that the 54.95? I'm trying to see. Is
And so
that
it
where I
looks like
re-entered? Yeah,
it looks like you re-entered at the 54.95, and then you did something that was
correct.
really interesting. You actually went back up on the call side. It looks like.
Yes, yes. And the reason was I remember there was a time when my puts, with one of these dips, my put position, it was kind of challenged. It had gotten a little bit above 1x. It was kind of well, yeah, it was, or a little bit above 2x. And I
Hmm.
was like, you know what, let me throw some risk on the puts on the call side. So if I do wind up getting stopped out on that side, it won't be so bad. Again, I always contend that it's better to have some risk on both sides, even though you think which way the market's going to trend. And sure enough, we wound up coming back and sort of stabilizing. So I was actually able to win some on even that roll down call position. So just a testament to the market was kind of up and down today. And then of course, I was able to also roll up a little bit on the puts and everything. So I wound up, I see I did like 30 contracts at like 50 cents each or whatever. So I had about 1,500 bucks worth of potential profit on each side. And so 3,000 was the potential to win for the day. And that's just about what it wound up working out when you add all this together there. So, but again, it just wasn't straightforward, it just wasn't straightforward. Yeah, I can hear you. Yeah.
Okay, I have
Yeah.
a few questions for you regarding this
hmm
because this is some really good trading. So initially, you started off on the call side at the
Yes,
54.90,
that's
50
correct.
55.35, and
hmm
and your put side was the 54.25. the
Correct.
I'm assuming the first thing that happened is that you got stopped out on the call side, and that's where you lost this 22.50 on the
hmm
call side on that short leg, correct?
Correct.
And
Correct.
and so what you did is that you took off that put short leg that you won on, which was $900, and then you rolled it up from the
hmm
54.25 to the
hmm
54.35, and
Correct.
you won another 840 there, and
hmm
for some reason the market kept going up, I'm assuming, and you decided you're going to
hmm
bring it up another 10 points
hmm
and
Correct.
collect another 1260, and you never
Yeah.
touched. This is a perfect example of what he teaches in statistical day trading course. He never touched that long leg, everyone, on that put side,
Correct.
but he
And
moved
the
that
call
put,
side either. Yeah.
or the call side, yeah, and you moved that put side up three times. And so now that's anyone can do that part. It's good trading, but I just say anyone can do that, right? Because the market is going in a certain trend, right? And so what you're doing is you're just keep moving the put up a little bit to gain some more monies. But what is more impressive to me is that you you took off this you got stopped out on the call side, and then when you moved it, you moved the call side from, let's say, the 54.90, you only moved it 5 points.
Correct. And that's always the challenge with the call side, right? I mean, the skew is so much less, you know what I mean? Like so,
Mhm.
you go from 5 points, one strike to another, and the premiums like doubled up, you know what I mean? So it doesn't take much room. Whereas on the put side, you got so much more room, you know? So yeah.
Yeah, so that wasn't a big move, but as we say, 5 points can be huge with a zero DT trade, right? That five
Hmm.
points can be the difference from, you know, losing a lot and winning a lot. And in this case, you were able to not have to adjust that call side again, which so you won 1440 there. But what's even more impressive to me than all the type of adjustments you did was that you kind of erased this stop out here. You thought
Correct.
you said, okay, I'm not even that's history, and you actually rolled the call side up past the
Hmm.
strike that you got stopped
Because
out with earlier.
Right, because at that point, what had happened was the put side was getting challenged.
Hmm.
And honestly, to be frank about it,
Hmm.
close to a double stop out. I was up to about, again, I'm doing these roughly at 50 cents credit, and I'd gotten up to like 1.1 or 1.2 kind of deal on the put side, and
Hmm.
and that's actually when I decided to put on that 54.85 and just
Hmm.
have some something on the call side in case we wound up stopping out and going back the other way. So it was really kind of a loss mitigation thing.
Hmm.
But fortunately, the market it finally kind of settled down. So even though I wound up being closer than where I originally
Hmm.
stopped out at,
Hmm.
it stayed stable long enough that I was able to win pretty good on that new roll down position. And the put side came back too. You
It
know what I
came back
mean?
big
So,
time. That
mm,
put side came back big time
mhm,
because you was just about to get stopped out, like you said, and but
mhm,
it settled down, and so you was able to win on both of those, which is great.
mhm.
And you were in this trade for how long
I
you were
was
in
in a,
this trade?
I got in a straight of I got in at 11:15 and I got out at like 2:59 because I was like power hour here, things could go
Uh-huh.
crazy. I was calculating. I was like, look, I've gotten what I kind of originally wanted to get.
Uh-huh.
There was still another like 500 or so to get on that
Hmm.
call position, and
Hmm.
maybe another 200 to get on the put position. So there's another $700 to get, but I
Hmm.
just I didn't want to sweat that out on power hour.
No, that's good. That's good trading too, you guys. You guys, you know what happens when we talk about the switching hour. When Dr. Meadows is saying power hour, he's using the same terminology as we say the witching hour. The power hour is a big,
Hmm.
it's a popular name out in the on YouTube and things like that on social media. But when we started doing this class, I wanted to change the name to the witching hour. So so I changed it to the witching hour. But anyway, same thing, right? And so it's a lot of stuff that happens during this last hour. And so you're saying you're not you you were able to overcome a stop out. You were able to trade this well, and even though you had 700, let's say, dollars still on the table, you wasn't trying to get that. You said, okay, I got enough out of this now. I'm going to move on. So $2,800 is an awesome day, and and the most you could have got originally, right, was three
Uh-huh.
thousand, right?
Right. Right.
So the after it adjusting, he actually was able to get very close to what he originally would have max been able to get, which is pretty awesome.
And the thing I want to point out too, I mean, we the market at the moment I got this trade was at 54.68,
Hmm.
and my short strike there was at 54.85. So I mean, it's not a ton of distance there in the
Hmm.
market.
Hmm.
And the thing that I've come to appreciate about trading in power hour too
Hmm.
is that the reason you can have such crazy moves is actually a reflection of the fact that the volume of trading and people participating in the market starts to go down. So it
Hmm.
doesn't take it doesn't take nearly as much buy and sell orders to really move things, and
Hmm.
that's the part that I've come to appreciate. About why you can have such drastic moves in that last hour. So I just, if I can, I'd like to just get out. But I used to hang more often, and I'm not saying I won't ever, but particularly if I'm still in a situation where maybe I haven't at least recovered back to even.
Hmm.
on a
Hmm.
trade, and I kind of got to stick it out the full hour or the full
Hmm.
day to get back to even. I think at least that kind of makes more sense. But if you're profitable,
Correct. And so you would only do that though if you're not stopped out again, right? So obviously just letting it play out a little longer. But if you're not back to profitable and you're trading within that last hour, but you're still going to have your risk management on, your stop loss on. So if
correct.
you get stopped out again, then you're done, perhaps, right?
Right,
Mhm.
right.
So it's not like what a lot of us have done in the past, you guys, or a lot of zero DTE traders out there. They sit there and they don't even have their stop on. They're just hoping and wishing that the market doesn't go past their strike, and that to me that is poor trading, and you're gonna end up blowing up your account by doing stuff like that. Dr. Metals has always had excellent risk management with this trade, and he continues to have excellent risk management, even if he had to hold the trade longer, as he's indicating. Any questions to Dr. Metals before we move on, you guys?
Question. It's a while to hear me.
It's hard to hear you, but we can hear you a little bit. Go ahead, Owanza.
The hands up pretty high. You're tied out here in Texas. Uh, the thing on the roller. Okay, my question is, how wide was the initial spread to start? And when you were doing the put roll ups or whatnot, were you making that width, that original width, wider than what it was before, or were you? Because I think O'Brien mentioned that you didn't move the long leg. So I imagine if
Correct, correct. And that's been a consistent thing with me, for the most part, ever since trading this. So you see the original spread, I was at the 54.25, and then my original long was the 53.60. So I'm looking for the first strikes where, the bid and ask are zero and a nickel. You know what I mean? And you're always
Mhm.
going to get that a lot closer on the call side than the put side. So it's pretty rare, honestly. If you really stick it out to 50 wide, you can get some that are like, 5 and 10 cents as the
Mhm.
bid ask. So you basically wind up paying 10 cents basically. But again, if you got the buying power, I like to go where I can get the first nickel on that put side, and then I don't touch it after that.
So this is one of those nuances that is not really a nuance. It's important with the zero DT trade, and it took me a long time to kind of realize this. Owanza and everyone else on the call, is that Dr. Meadows has been saying this from the beginning. This is how he operates with the zero DT trade. He did the course on it, and I always thought that I could just move the whole spread, right? And but moving the whole spread makes it more challenging. It's like an iron condor is harder to adjust than a strangle. And so what Dr. Meadows is basically doing is this is just a strangle for him with some really really long, you know, whiffs, or just the like a placeholder for him, just to help with buying power for the long leg. So he disregards that afterwards. And when he adjusts the short leg only, he don't have to adjust as big and still get a good credit for it. And I didn't realize that for quite some time, that is a key to adjusting this zero DT trade to make it easier, and in my opinion, to adjust, because you can still stay at reasonably fair deltas when you adjust the trade.
Hi, can I ask a
And
quick question?
yes.
It's probably just me and my dyslexia, but
Mhm.
this page is hard to conceptualize. Can you show the setup what it would look like if you were doing it on TastyTrade uh, initially?
Okay. Yeah, yeah. So, but if I go to Tasty Trade, and it's gonna be harder to kind of it's the if we go by the original strikes, right? So it's not gonna look the same. So the original put side was 54.25. So its original put side was this. I'm just gonna put the short leg so you can see that was the original short leg on the put side, and then on the call side, his original short leg was the 54.90. So so if we go here to the 54.90, it's going to look like that. So I'm just going to put the strangle so we can see it on this page. The Just keep in mind his longs are way over here and then way down here, right? But if you see the strangle, this is how it looks. So it obviously it looks like it was an awesome trade now, but the market had this intraday volatility, so that he was originally stopped out on this trade, right? And then and that he rolled this one up. So at the end, his trade looked like this. He put the call side. That call side ended up here, and the put side. If let me just double check and see what that put side. That put side ended up at the 54.45. So it ended up like this, but it still looks good now. Obviously, things settle down because this is where the market is currently trading right now, and this is the expected move. It would be a good trade now, but once again, this wasn't an easy trade. It was his adjusting skills are very very strong, right? It's like like Star Wars, right? The force is strong with him.
so Brian, These
Yes, sir.
traders accordion in those short strikes, making the whiff wide, maybe starting 50 points wide. But if things, if he needs to roll up, he's making that 50-point wide, maybe 65-point wide, etc. Right?
Correct. That is correct. It might sometime become it all depends on how much you have to roll up. It could become 100-point wide at one point, right? But you have to have the buying power. You have to have the buying power to do that. What I have done is I might start a day trade with a 20-point wide, and then I use his method of only touching the short legs. And so you guys will see me do that in the ES now a lot. And that's it just helps so much more to be able to get the premium. So for example purposes, if I was if I went if I went here, and if this is the trade, and I just gonna move it up, if I can get my hands to work here, I'm just gonna move this trade up 5 points and sell this. Well, this is gonna give me $45 if I did that. If I had some type of long leg, that might take too much of this away, right? So moving just the short leg is actually a strategic type of advantage, I think. And I don't know that if that's why you originally started doing that way, Dr. Meadows, or what, but that the way you've done it all these years is played out to be, I think, the best way to do it. So you're gonna have to need a little bit more capital on the side to be able to deal with the spread getting wider sometime. All right. So any other questions? I don't know if let me see if Dr.
Yeah, I
Meadows is
just one
still on the
question.
call.
I
Go
mean,
ahead.
but if you were considering doing the zero DTE in the SPX, would you suggest that your account needs to be greater than 25K? Because I've been listening to some of the course, and it seems like when you have those stop outs or whatnot, that would count against your pattern day trading rule. So would you
For you
suggest,
talking about for the SPX?
yeah, for the SPX?
So absolutely. If you're gonna day trade with the SPX, you can't do it. You can't do it with the SPX without having the right size account. You can't do it the way Dr. Meadows teaches in that course. Once again, it's a statistical day trading course, because it's it's imperative that you have your stops, and every time you get stopped out and you put the trade back on, that would be a day trade then. So you can't do it. You can obviously do the 1 DTE the way we teach that in the 1 DTE course, right? But you can't do the 0 DTE in the SPX without having the right size account. I
Oh,
mean, if you do it, you're gonna if you adjust too much, you're gonna get a day trade and your account's gonna be locked up. So it's just not a smart thing to do. Go ahead.
I was just gonna ask for strangled.
Mhm.
What kind of collateral is needed for something like that?
So that's why Dr. Meadows is using the wide. He starts off at like 50, or sometime a little less on the call side, but sometime a little more on the put side, is for the buying power usage. So even if you had portfolio margin, it's going to require more buying power for that 0 DT trade, because the closer you get to expiration, the more buying power they require. So in this case, it's regular T margin. And so if you were going to do a strangle on this, let's just say you decided that you were going to sell this 5 delta, and I'm using 1 day because it's the 0 DT is just it's over basically, right? It's only 30 minutes left. So if I did a strangle here, and I just say I did it at the 4 delta on this put side, well, you can see that this is requiring buying power of over $100,000 to do a strangle in the SPX. So it's just way too much. It's a big index, as you guys can see, and it's just way too costly. It just costs too much. So, but if I make this 50 points wide there, right? And then I just say I made this, 50 points wide. So what would that be? That would be here, right? So that that's going to keep the buying power reasonable, right? So in this example, it's just under 5,000 per per for Aaron Condor that we're doing here. So that's going to make it, you don't have to have a $100,000+ account to do this trade. And if you make it less wide initially, I just say you decided you're going to do 20 points wide. Well, it's going to require less than 2,000 to initiate the trade. But if you still allocate more capital to it, let's just say for example purposes, you had to adjust the call this put side, and the put side had to come to here. Well, if you had to do that, well, that if you started with 5,000, you were able to bring that put side up quite a bit and still have enough buying power for it. If you had to bring the put side all the way up to the at the money, it'd still only be like 6,400. So you don't need to have, doing this with an account size of 30,000, 35,000, 40,000, 50,000 to be excellent, in my opinion. And it'd be great. Obviously, if you're doing it in an ES, that you don't have to have an account that size. If you're doing it in ES, you can do these zero DT trades with an account of 5K, and that would still work, because you can adjust this any way you want without having to have the day trading pattern rule situation, right? So that's that. But it's trade-offs to ES. I would, if I had my choice and it wasn't a capital issue or something like that, I would do it in SPX. But it's not always that case for most. So there we go. All right. So any other things on this before we conclude on this topic, this zero DTE topic? All right, so awesome. Thank you, Dr. Miller. That was great. I hope that if you're ever interested in the zero DT trade, to me it's imperative, it's a must to go over that statistical day trading course that Dr. Meadows did, and if you follow it completely the way he does, you're gonna make money. If you deviate, maybe you can make some money, but I do know for a fact if you do it exactly the way he teaches, you're going to be consistently profitable with the trade.